when is the right time to start taking advice if you're having some issues with HMRC?
If the issue has already arisen, then as early as possible. Naturally, the best situation is to always have someone on board in addition to your accountant, or being, sometimes you have to be proactive with your accountant as well, which is that doing a bit of research yourself, asking the right questions. I'm not expecting business owners to sit there and start reading about tax legislation, but I don't know, it's a fine balance, but ultimately the sooner the better.
Most people think tax is boring until they're faced with a massive tax bill, a penalty, or they're missing out on thousands in savings. Today I've got someone who actually makes tax interesting. Omar Aswat, Chartered Tax Advisor, LinkedIn Goldmine and founder of Aswat. If you've seen his posts, you'll know he's not the normal suit and tie tax advisor that you might see elsewhere. Today we're going to dig into real life tax planning, avoiding HMRC nightmares, and how smart business owners are protecting their money the right way. Omar, welcome to the Director First show. Thanks for driving up here and seeing us, pal.
Thank you very much for having me on, Chris.
No,
great to be here.
You're welcome. Yeah. Listen, I wanted to start off. When you tell people that you're a tax advisor, what's the first thing that people usually get wrong about what you do?
So I think the first thing is when sometimes, it's happened a couple of times, where someone asks, what do you do? And I say, tax advisor. And they say, oh, so you're a taxi driver.
Yeah.
And then I just let them, yeah, that's fine, okay. But tax advisor, I think I think different people will have different views in terms of what exactly a tax advisor does. Sometimes people have this understanding that as soon as you say tax advisor, they think you work for HMRC. So, they'll make a joke, oh, we need to stay away from you, for example. But then I think in the financial services and professional space, most people would understand that, we're not just your accountants, we're slightly, we're at a bit of an angle whereby, we're specializing in tax, and we're specifically looking at tax matters. Now, tax is a very, very broad subject. There's so many different areas. I can name 10 right now if that's okay. So, you have income tax, corporation tax, capital gains tax, inheritance tax, trust taxation, property tax, international tax, ATED, annual tax on envelope dwellings, stamp duty, land tax, VAT. That's just 10. I can probably say a few more if I wanted to. So then I think when it comes into the professional services space, many would start asking, okay, what do you specialize in? And that's when you can continue the discussion.
So, like for me, and we sort of talked about it off camera, you don't want to be introduced as an accountant, okay? Now, for those that are watching, what is the difference? Because there'll be people watching this going, well, that's what my accountant should be doing, surely. Mm-hmm. What's the difference?
That's a great question. So the way I put it is that an accountant generally will be looking at your historic records. Mm-hmm. And this is the key difference, because I have many conversations with accountants, and a lot of our work comes from accountants, and that's, you can already see the difference. Why are accountants sending work to us? They send us work in relation to their clients' specialist tax advisory needs. So general accountants would be more historic in terms of accounts to Companies House, mm-hmm. CT 600s to HMRC, self-assessment tax returns. You're looking back, right? You're looking back 12 months, 18 months, sometimes 23 months because of the dates and the funny dates that the UK tax system sometimes has. So effectively, in terms of the difference, I think tax advisors are generally more forward-looking, and it's our job to then look proactively. I had a discussion just last week with some accountants up in Scotland, And they asked me, the two partners, they said, how do we scope out tax advisory work for our clients? How do we know our clients need your services, specialist tax advice? And I told him, I said, it's all about the conversations. With the financial records, bookkeeping, accounting, you're looking backwards. That's not really much benefit to anyone, right? You have to, the only way you know is by having conversations with the client. For example, the client might turn around and say, I'm looking to retire in the next 5 years. Now, immediately for me, that's tax advisory, which is we need to start planning the structure of the business and, understand the individual's personal and family objectives after retirement for us to then plan in a tax efficient manner. Most people, they'll end up leaving things too late, and that's because these discussions have not been had. It's always been the accountant looking at the historic records, and I'm not throwing shade on accountants. What I'm trying to say is we do different jobs. Tax advisory is definitely and always forward-looking. There are instances where we look back at financial records, for example, when we're making claims, so research and development tax credits, capital allowances on property. That's when we'll look at historic records, but most of the time, 90% of the time, it's about conversations. Another example might be you have husband and wife and they own 10 properties, for example, and they now want to step away from the property business, but they still want the income from the rentals, but they want to start introducing the younger generation, their children. Now, how can you deduce that from financial records? It's impossible, right? Mm-hmm. So it's all about the discussion. I think that's the key difference. In terms of tax advisory specifically, again, we're not really looking at compliance. We're not ticking boxes. There are aspects of it, which is, for example, the inheritance tax 100 form, complex self-assessment tax returns. But a lot of it is about sitting down with clients, assessing their situation, understanding their objectives, and then from there, devising a plan, a restructure, whatever it may be. It just depends. But as I say, it's all about going forward.
And so how did you, where did you start off?
Yep.
What was the journey, and sort of how have you got to this stage now, founder of your own firm, get a lot of engagement in the information that because that's where we found you, LinkedIn, you were somebody who made, we say it a lot, that my industry, people say it's boring, your industry, it's exactly the same. Mm-hmm. So when you sort of stand out as someone and go, you know what, that makes sense. Because like for my industry, we have people that just spout the Insolvency Act. And that's really important. In most cases, it's not very helpful for the director because they're just like, oh my God, what does that mean? Mm-hmm. So what's the backstory?
So I did start out as an accountant. Maybe that's why I'm passionate to say I'm not an accountant anymore. Yeah. So I started out as an accountant. My father is actually an accountant and he sort of pushed me into that direction. But I did study accounting at A levels and accounting and finance at university. Started out as an accountant, went out on a few audits early on and realized that this is definitely not for me. I mean the audit aspect. Personally, again, I might get a bit of hate for this, but I found audit very repetitive in terms of the actual day-to-day. And then I was I gained some insight into taxation. Now, one thing is repetitive and day-to-day, which is audit. And then when you look at taxation, rules are changing constantly, right? Mm. Legislation, budget, further tax rises, to be announced end of this year, most likely. And also just helping people with something a bit more real, as in I'm talking about your normal day-to-day people. For example, individuals that have to file self-assessment tax returns, business owners, directors, shareholders, family members of such families when we're looking at inheritance tax planning. And I'm not too sure exactly what it was, but for me that was more like bringing some inspiration from my creative side, which is it's never a sort of one solution fits all when it comes to tax. And I started to pick these things up. It's like, okay, this person has this situation, this person has that situation. It'll never ever be the same. You'll never ever see two cases that are exactly the same. There are always nuances. And I enjoy that kind of thing where I have to sort of think outside the box and, assessing situations, navigating family dynamics sometimes, where we're looking at, we're looking at assets, wealthy families, and then, some marriage issues, whatever it may be. But for me, I can see the direct impact and the benefit that I'm bringing to clients. So that's effectively the backstory. I set up Aswat Tax 4 years ago, and to be very honest, the first 2 years, very quiet, very slow business. I saw
in your post last night.
Yeah. So, and the way I see things is, we have to try to see the best in every situation. So, although the 2 years were quiet, the amount that I learnt about, people in the industry, how to speak to clients, how to market, how to sell, all these kind of aspects, I don't think I would have learnt if I was busy in taxation from day one.
Can I jump in there?
Yeah.
Is that a professional talking about how to market and how to sell? That is a dirty word for a lot of people. I'm so glad you brought that up.
Mm-hmm. It's a necessity.
Yeah,
the way I see it, as I just mentioned, if I went straight into taxation and busy with clients and dealing with this legislation and this situation, I would never have probably been able to take a step back and understand what exactly am I doing. I'm running a business. Mm-hmm. And the other thing is sometimes, is with my knowledge of sales and marketing, and I've read many books, been on a few courses as well, I just feel like I can advise clients better as well. So it's like a win-win for everyone. Understanding different aspects from different lenses, I think that's quite beneficial. And ultimately, without sales and marketing, sales effectively, there is no business.
Listen, I'm absolutely with you. People sometimes have pot shots at us and say, "Oh, they're all over LinkedIn. They do YouTube. We don't do that. We just work on referral." I'm thinking, okay, our thing has been, we're going to make something that's really complex, and there was so much not misinformation out there, but a lot of people's approaches.
Yep.
They would just, like I say, they taught the Insolvency Act, but they wouldn't boil it down to what matters for the director.
Sure.
So that's what we did. We just went, right, listen, how can we make this really complex subject? Oh, crikey. It's like, that's the problem with live TV. How do we boil it down to make it really easy for people to understand so we don't lose them? But
sure.
Even now, some people they think that the business will be successful just because they're good at what they do. I think we're in different times now.
Oh, 100%. I think those that think like that will get left behind, with apologies. But I also believe that, or feel that, many are starting to pick up on the new times, which is that we need to start looking forward, get with the times. It's very important what you mentioned, even from a tax perspective, which is, if we come back to LinkedIn, because you've mentioned LinkedIn, some tax advisors will post about very technical topics, and they'll have legislation there, and it's very good, as in, for me, I'm learning, I'm benefiting. But then you have to sit back and think, it depends why they're posting in the first place. If they're looking to gain clients, then I don't believe that's the way forward. If they're looking to impress fellow tax advisors, that's fine.
It's a pissing contest, isn't it?
Exactly. So with clients, again, with taxation, and I've been praised for this many times, it's about getting the legislation. Clients do not care about your fancy 40-page report regurgitating legislation and this test and that, and this is the case law. all they care about is how can we, you have the knowledge, you're the tax advisor, you use your understanding and your experience and bring a solution to me, as long as it's in accordance with tax
rules,
law.
Yeah.
That's all it is. It's nothing more, nothing less. It's about making something complex, as you say, or getting something complex and fitting it in the client's circumstance and making it easy for them to understand. Again, as I'll say it again, clients, they do not care about, they probably don't even care that I'm a chartered tax advisor. CTA doesn't mean anything to them. It means within our industry, accountants, tax advisors, insolvency practitioners, wealth managers, oh, he's a chartered tax advisor, excellent. But your client that's running a roofing business or construction business, he's the 100% shareholder director. Mm-hmm. He doesn't even know what CTA is, he or she. So I think it's important to balance things out where we be technical where we need to, but at the same time, there's no benefit for that technicality if the client is not benefiting.
Mate, I'm absolutely with you. We are exactly the same here. Our role has always been it's director advisory, and we have 7 licensed IPs that do the insolvency practitioner's role. They have all the governance, they have all the compliance around them.
Sure.
Our role is to go, right, what's the problem? Really find out what the problem is, because they might not know what the problem is. Mm-hmm. They come to us with one problem, and we actually look around and go, well, actually, this is this, that, and the other. And okay, what's the outcome that you're looking for? What legal options have we got available? You might not get the ideal outcome, but can we get you from A to B legally within the law? Mm-hmm. And we try and make it as if I start saying words that people don't understand, or I go too technical, and that can happen. We can have a call. There'll be me. There might be our Sean. Mm. We might have a solicitor on the call. We've got 2 directors and we've got an IP. And then everyone just starts talking in jargon. I'm like, whoa, slow down. Because they don't know what misfeasance means. Exactly. They don't know what this section of the Insolvency Act means, and it really puts, and I think that's why people have so much, because some people are scared to talk. They're certainly scared to talk to someone like me, and I think you mentioned the roofer. Okay, I've always felt that tradesmen are scared to talk to accountants or tax advisors or financial advisors, and that sort of brings me on to my next question. There are people out there that might think, well, why do I need a chartered tax planner like yourself?
Sure.
So who is it who actually needs your services? Because we have people out there thinking, it's all right this, but I don't need that. I've got my accountant. Okay, I want to really hammer that home.
Sure. So as we say, the general accountant will be in charge of compliance and reporting activities. So they'll make sure that everything that needs to be done is done. But with us, we're looking, and again, I want to say we work closely with accountants. So it's not like us against them. It's not chartered tax advisors against accountants.
I get it.
But for the director, for example, that's thinking, okay, why do I need to speak to Omar, for example? If you want to save money, you need to speak to me.
I like that.
Because what we're doing is we're looking forward and we're trying to understand what you are trying to achieve, and what we'll do is we'll implement that in a tax efficient manner. Or it might even be current situation where you're extracting dividends and salary. That's like the normal go-to. Every accountant will recommend salary plus dividend top-up. Okay? But you might be running a successful, profitable business with, I don't know, £500,000 sat in the bank, on the balance sheet with cash in the bank or retained earnings. So it's one of the lines on the balance sheet. And your discussions all these years with your accountant has been that the more I extract from the company, the more tax I have to pay, which is right. Okay, so we're on the same page. So then you've always been thinking that I don't want to be doing this my whole life. I want to start investing in property, or I want to invest in stocks and shares. Like, this money is just sat there on the balance sheet in the company bank account, and I'm not allowed to touch it. But then you answer yourself, because of all your conversations with your accountant, that I can't touch it because I'll be hit with a 39.35% tax bill. So 40% of the money that I take out, it'll go to the taxman. And that's where people like us come in, because we have structures, strategies and solutions that allow you to achieve your goals in a tax efficient manner. And most people, they'll have no idea their whole life that these structures and strategies are available.
Okay, let's dive into it, right? So I've recently done this, by the way. I've actually got my clearance now from HMRC. Because one of the things I think you might want to talk about now is a holding company.
Sure.
Can we start to get into that, like get into some real meat and potatoes? Let's say there's a director out there, they've got a healthy balance sheet, they've got some cash in the bank. What can they do? How can they extract that money without giving it all to HMRC?
Fine. So the default position is, if I give an example, £500,000 sat on the balance sheet. If the default position is, if you extract the £500,000 as a dividend, then 40% is gone to the taxman. So you're left with £300,000, and you've paid £200,000 in tax, which is unacceptable. Okay. Dividends, however, between companies, not with an individual, which is the director shareholder, are tax-free, exempt for corporation tax purposes. So that's where you have the trading company here at the bottom. That's where the money is stuck, £500,000. You insert a holding company on top as a shareholder, effectively, and the £500,000 can go into the holding company completely tax-free without any tax wastage. So now £500,000 is sat in the holding company. That holding company is a separate legal entity, and that's where you can undertake your investment activities. Now, one may think, and this is, we have to be very open. When we're presenting solutions, we have to explain the pros and the cons, okay? So one may think now, well, I still don't have the money in my own pocket, right, in my personal name. But that's the point. That's where we have those discussions, which is, what exactly are you trying to achieve? If you're looking to invest in stocks and shares, crypto with the younger generation, and property, then, and depending on your goals going forward, then naturally investments are better undertaken within a corporate wrapper. Okay, for many purposes, the commercial and legal protection, again for tax efficiency, where you have 19% corporation tax versus your 40-45%. And what you've done now is you've extracted the £500,000 and invested via the holding company. Now, if you really want to go into the meat of it,
yes, please,
then there's a better solution which is more well-rounded, which is the holding company on top, but then you have a family investment company as a certain percentage shareholder of the holding company. Why do we need to do this? Because one of the main reasons is to preserve valuable tax reliefs, primarily business asset disposal relief for capital gains tax and business property relief for inheritance tax. If we dilute, so here we have the trading company and the holding company, and then top right, you could say, is the family investment company. The reason the investments should be undertaken top right and not here in the middle is because we want to preserve this at the bottom, holdco and tradeco, as a trading group. It has to be a trading group. If we lose trading status, then HMRC will class it as an investment group, and therefore we will lose out on business asset disposal relief for capital gains tax purposes, which allows you to extract yourself from the business at 14% rather than 24%, and business property relief for inheritance tax purposes. So, as in the worst case scenario is you dilute this group and it becomes an investment group, and what was previously exempt from inheritance tax at 40%, the whole value has now been brought into your estate. Worst case scenario. And that's what we're just trying to protect. And we can only, if we go back to the original question, we can only help business owners if they have these conversations with us. Otherwise, we have no idea what you want to do.
And it's worth saying that all this strategic planning you're talking about, not everybody can do this. Like I actually went to my accountant first of all. He said, Chris, I actually don't do this.
Sure.
People need someone like you to get the relevant advice, because you've got to get certain clearances. There's got to be right pay. It's got to be bulletproof, hasn't it? Because it's not something that can go, oh well, I'm not going to pay that fee. I might as well just set up a company here, company there, and called it holding. It's really specialist advice that people need.
Correct, 100%. I think there's a few points I would want to make here. Number one is that, as I mentioned earlier, 60% of our clients or our work comes from accountancy firm owners. So that already tells you that they know what they don't know, and they therefore refer the work onto us. The second thing is, you're right, which is that if something goes wrong somewhere, then what you thought has been achieved on investigation or inquiry by HMRC is actually not being achieved because something went wrong somewhere, and therefore you end up paying significant amount of. So there is a case going on right now, which is an accountancy firm. They were selling a scheme effectively for property landlords, and I know your correct me if I'm wrong, but your client base is more trading business owners, or is it property landlords as well?
Well, the last few years with the increase in mortgage rates, and we've actually done a lot of work for developers and landlords.
Excellent. So accountancy firm selling a scheme to property landlords, promising them the world.
I remember.
And now what's happened is HMRC have looked into it. They've said it doesn't work. All those that have been using the scheme for the last 10, 15 years are now, or will now be subject to massive, gigantic stamp duty land tax charges. And most of the time it'll end up being double, because effectively you'll be charged on what happened back then, which is the property went into the corporate structure, for example, but then you'll be charged on the property coming out as well, back into your name. So the bottom line is, these are one-off transactions. These are not transactions you do every 2 weeks, okay, or it's not an annual thing. Once you set up a new structure, or the setting up of a new structure, or inheritance tax planning, whatever it is, when it comes to tax advisory, you're leaving the country, you're coming into the country, it's a one-off situation, it's a one-off event, it's a one-off transaction. And therefore, it begs the question, why wouldn't you take specialist advice, get it done properly, and sleep well at night?
You did a post recently about HMRC penalties, and people saying that, oh, I'll deal with it later.
Yep.
What's some of the worst case scenarios where people have left it too late and it's just gone kaboom?
That's a beautiful question, just because we're dealing with a client right now. And he's had penalties that he's just left there since 1998.
Wow. For
him and his wife. And the penalties have racked up between the two of them over £2 million. So I think 1.2 million for the husband and £800,000 for the wife. And there's a few things at play there. One is, he's a successful businessman. He owns over 100 properties. So if I'm being very open, there's a bit of there's an angle of where he's playing naivety. which is I didn't know. But that's not acceptable in HMRC's eyes. You know, you can't just turn around and say I didn't know, especially if things have been racked up for 24 years, 25 years, or 27 years now. So the bottom line is get things done right from the start. If things go wrong, then get things rectified sooner rather than later, and always seek specialist tax advice, not because I'm trying to sell to your audience, only because we've seen so many things go wrong, where, you know, this individual, he manages the day-to-day affairs. You know, he thought it's fine. But at a certain point, it's not fine, and that's where you have some serious issues. And you know, we're well versed, we're experienced in dealing with HMRC as well. There's a certain way to deal with HMRC, as you guys would know. It's not just about if they ask you a question, you just give them everything and anything. Yeah, you have to be strategic as well. If you just, you know, HMRC sometimes they can, you know, for example, they'll send a nudge letter, and these nudge letters, it sometimes throws taxpayers off. They start panicking, and then they send more information than they actually needed to, and they open a massive can of worms, which you know, you have to be strategic about dealing with HMRC.
We see it a lot. So HMRC at the moment are a really aggressive creditor. It's a small business, any size businesses really in the UK. HMRC are very easy not to pay. Like, if you are a small business owner, you've got your suppliers screaming, you're struggling to make payroll, and you've had a bad quarter, and you've got your VAT stashed away in the VAT account, people will go, you know what, I'm going to use the VAT, I'm not going to pay the PAYE, and I won't pay the corporation tax, and I'm going to sort it next quarter. And at that stage, they're like, they really believe things are going to get better. And they don't really hear anything other than a nudge. And then something happens the quarter after, and before you know it, they are 2 quarters behind. They've not paid the payroll for 6 months, and they're 6 months late paying their corporation tax. And then that escalates, and now we're seeing the revenue. The big things at the moment, Omar, is control of goods. So if they're not getting any proposals to repay, or they're getting proposals to repay and then they get broken, they're going in with a clipboard, writing down all the assets, get them the director to sign it, and after that, the HMRC owns their assets. They might not take them on that day. They won't take them on that day. But from that point, if you don't pay your arrears in full, they're going to come and take them. And the amount of winding up petitions I've seen recently, the past 6 months from HMRC, and it's almost always one of two things. They've buried their head in the sand and think it won't happen to me, or they've gone to the table with the HMRC with no advice, and they're that desperate to get rid of the problem, okay? They're agreeing to arrangements that they're never going to be able to stick to, and it gets rid of the problem for 2 months, and then they ring in and it's too late. So when is the right time to start taking advice if you're having some issues with HMRC?
If the issue has already arisen, then as early as possible. Naturally, the best situation is to always have someone on board in addition to your accountant, or being, sometimes you have to be proactive with your accountant as well, which is that you know, doing a bit of research yourself, asking the right questions. I'm not expecting business owners to, you know, sit there and start reading about tax legislation, but I don't know, it's a fine balance. But ultimately, the sooner the better. And naturally, always, you know, prevention is better than cure. So try to have everything covered beforehand as far as you can, as best as you can.
You've worked with a lot of high net worth individuals, a lot of entrepreneurs, a lot of business owners. What's the one mistake that you keep seeing people make that keeps biting people?
Good, excellent question. Putting me on the spot now, as you said you would. one angle would be around inheritance tax, whereby high net worth individuals, business owners, property landlords, I don't know what it is, I think it's a lack of awareness and perhaps education, whereby they just don't believe inheritance tax is something that is as serious as it is, or it might be that we're not affected by this tax, okay? And therefore, they have no clue, no awareness that on death, their estate, or the next generation, the younger generation, they'd have to end up paying, hundreds of thousands, maybe millions in inheritance tax. So it's a mistake in the sense that inheritance tax is completely being overlooked by many people. As soon as your estate exceeds £500,000, and that can easily be exceeded with, your main home, for example, especially down south. If you run a profitable trading business, then £500,000, when you start looking at EBITDA and the calculations, £500,000 is easily exceeded. So once you exceed £500,000 and 1 million as a couple, then anything in excess is subject to 40% inheritance tax. And that's not a small amount when you really think about it.
It's frightening.
It's like you've paid tax. Frightening. You've literally paid tax all your life. You're paying income tax, corporation tax, capital gains tax, stamp duty, land tax, whatever you're paying. And then you have this other tax on top when you die, which is 40%, and you're not even aware of it. That's the mistake. And that's what I'm trying to sort of build awareness around. And the other point is, now I'm not trying to scare people off. What I'm trying to actually tell people is that there are so many strategies that we can explore for every individual. It's just about, as in, we're here to help you, we just need you to reach out to us. Because even, for example, gifting, it won't cost you too much in professional fees in terms of our advice. But, for example, we charge between 3 to 5K for an options report. So it's the first stage of any inheritance tax work that we do.
I'm really glad you come out with the price, because people need to know. We've got to be really open with what we're going to charge, aren't we?
Correct.
And that'll get rid of people that don't. If someone doesn't see the value in what we're offering, there's literally no point having any chats with them anyway.
Correct.
I saw your post last night about the guy who's.
Oh yeah.
But it's important. This is our price because this is what we're going to offer. Sorry for jumping in, but it's a mega important. I've asked people the question, what do you charge, and they're like, don't really want to say.
You start jumping around. Yeah, exactly. No, I think I'm very open with pricing. Obviously, most of our projects are bespoke priced, but this, because it's like a pre-stage, we have a fixed fee, which is 3 to 5K.
Tell us about that. Yeah, okay. Tell us.
Now, the benefit with that 3 to 5K is, number one, a peace of mind and clarity. So forget everything else. You know exactly where you stand, because the start of our options report is understanding all your affairs. Okay, so main home, what's the value? Okay, let's put a value to it, £700,000. Shares in this trading company, shares in this property investment company. You have some pensions. You have some artwork, paintings, whatever it may be. But what we've done is we've understood your situation in the first place. So we've spent time with you to understand what your situation is. We then undertake a calculation in terms of, if you do nothing, then this is the exposure. And then from there, we set out the options, which is, okay, this is the current exposure. If you do nothing, this is the exposure. And I've had the one or two individuals, they've said, oh, I don't mind, I don't care about my children. I'm happy to pay HMRC, and then they'll deal with it, which is fine. But most people, they'll realize that now, okay, this is a £1 million exposure that we're facing as a family. And that's where we start, understanding objectives, personal objectives and family objectives, okay? Because if you're losing 40% every generation, that's how wealth is eroded for many families. Rather, on the flip side, you pay 3 to 5K, and we've literally we've unlocked your mind, we've unlocked possibilities, which is, okay, option one, we could do this, okay? These are the benefits for you, these are the disadvantages. This is how, and the other thing to remember with tax is sometimes you can't have everything, okay?
Yeah.
So, you know.
I get it, mate, I get it, yeah.
Yeah, for example, on a high level, you can't save tax but then still have control. Sometimes there are family investment companies that allow for both, but for example, when we're using trust, discretionary trust, you know, if you transfer value out of your estate into the trust, then you can't benefit from that trust. It's the beneficiaries that can benefit.
Which would be your family or next of kin.
Children, grandchildren, exactly, family, wife, husband. So, as I was saying, I forgot the last bit I was saying, just before the trust.
We was talking about
the options.
Yeah.
So pros and cons, how can we fit this into your objectives as a family? What are the professional fees or legal fees? But then ultimately, what are the tax savings? So we do all the calculations for you, which is if you follow this step, this option, do this, that and the other, your £1 million tax bill will come down to £200,000 on death, for example. Now that's an £800,000 saving for our 3 to 5k fee. Well, yes, there might be other fees, you know, to set things up later on, but sometimes there's so many times we've eliminated inheritance tax by simple changes.
Can we get into a little bit? And again, no one's going to be able to come off this podcast and go, I'm going to do that. They're going to pick the phone up to you, right? But can we sort of talk through some very high level options of how people can get more of their estate to their loved ones as opposed to give it to the HMRC, who right now at the moment are, for me, they are a bad steward of our money in the UK. I don't want to go political, but this is important stuff, isn't it?
Sure. In terms of tax planning options, case by case basis, as I always caveat, but for example, it's always better to start with the simple stuff and then get more exotic. Some clients, they'll read something online, they'll see a TikTok video, and they'll be talking about...
My missus gets all her information off TikTok. That is where she gets her ideas from at the moment.
So they'll see a TikTok video and they'll be pitching that video to you. They'll be like, oh, can you do this for us? And I'll be like, why the hell do you need that? As in that's nothing to do with you. Your estate is just about 1 million and you're talking about a solution that's for those that have estates worth 50 million, for example. So I think the first thing is to start basic. When it comes to inheritance tax planning, any planning that we do, we always make sure that the basics are covered first, because sometimes those are missed out as well.
What are the basics?
For example, if we're looking at business, like make sure all expenses have been claimed. You know, you're talking about all this exotic tax planning, but you've missed out £6,000 professional fees here, you've missed out this, and you've structured this slightly incorrectly. But for inheritance tax, the basics would be cash gifting. Okay, cash gifting is good because there's no capital gains tax issues that we need to navigate. There's no stamp duty land tax issues. And for the viewers, when it comes to inheritance tax planning, it's usually surrounded by capital gains tax and stamp duty land tax, because inheritance tax and capital gains tax are wealth taxes, okay, and then usually the majority of people's estates consist of property, so that's why we're looking at stamp duty land tax. So with cash gifting, you don't have any further issues. It's just a cash gift. For inheritance tax, there's a rule around the potentially exempt transfer, and this is something that's going to be discussed in the upcoming budget.
Hold on, that's my next question. Let's not go to autumn just yet, right?
Fine. So if you survive 7 years from the date of gift, today is the 21st of August, I think?
Yep.
21st of August 2025. 21st of August 2032, that value, let's say you transferred £500,000 to the next generation, even if it's £100,000, that value is outside of your estate for inheritance tax purposes. So you've saved 40% of £100,000 without any, as in there's no professional fees, there's no legal fees, That's all within our report. We've just told you to transfer this cash here.
And you've got to live 7 years after you transfer it.
That's the thing. You have to live 3 years to begin with, and then from 3 to 7 years, you have something known as taper relief. So your IHT bill does reduce, but after 7 years, it's completely eliminated.
Unbelievable. Absolutely unbelievable.
And there's another one, again, there's another one which is completely underutilized by the masses, but also by accountants and tax advisors, which is gifts out of excess income.
Okay.
Gifts out of excess income, which is if you have excess income coming in, okay, you might have investment properties, you might have investments, pensions, whatever you may have, the excess income can be gifted to beneficiaries without waiting 7 years.
Okay, how does that work?
So as long as we can argue a case that this gift of cash is from income that the individual does not need, and there might be some financial modeling and things like that we have to do, but as long as we can argue that angle, then that amount or that value is outside of the estate immediately. That's the key point, because this works well for those that are, you know, in the 70s and 80s, immediately outside the estate for inheritance tax. And when it comes to inheritance tax, again, the sooner, the always better. Why? Because the later you get, the less options we start to have. Okay? And then you have clients, they'll come to us. I have a client, he's 85 years old, and him and his daughter have approached me, and with apologies, they're jumping around, you know, pushing me to find a solution for them. But we're very limited. He's 85 years old and not in the best of health as well. And so these type of cases is sad to see, and that's why I try to, you know, push myself out there, which is, you know,
when should people be people taking that advice on inheritance tax planning? Because one of the reasons I invite people is because I know I'm going to learn stuff, and I get to lock someone down for an hour and get some really good advice.
Sure.
And I've learned a lot already today.
I appreciate it.
And it's not something I thought of.
Mm-hmm.
It really isn't. It's like, you know, I'm fit and I'm healthy, I'm 42. Yep. Are you saying I should be looking at this?
It depends. It depends on individual circumstances, for example, health issues and that kind of thing. But generally speaking, I think once an individual is in his or her 50s, and definitely in their 60s, they need to start seeking advice as early as possible. But then that's the thing, again, very subjective, and with tax planning, and this is why I enjoy it, this is what I said at the start, it's like, it's never one rule fits all. So for example, again, you might have, so I do have a case right now where father, you know, he a very successful businessman, and father and mother, you know, they own lots of property in the millions, but the son is also successful. So parents are in their 60s, son is in his late 30s, early 40s, and he's also very successful. So he's already got value within his estate already. So who needs to seek advice now? The parents definitely need to seek advice, but it needs to be collective advice, because there's no benefit in transferring millions worth of assets to Tom, we'll call him Tom, and, you know, we're just loading up his estate now, and then a few years later we'll have the same problem.
Yeah.
So that's where we start thinking now, okay, how should we navigate this? Do we need to start looking at trusts? Do we need to transfer assets directly to, or, you know, by skipping a generation? That's one of the angles we look at.
Can we talk about trust? Because I hear a lot about these, and again, I can't see the wood for the trees with them. So someone who is watching, they have no idea what a trust is. Why are people talking about them now? If you can break it down as simple as possible, what are the benefits, what are the drawbacks?
Okay, so trusts, there are different types of trusts to begin with, just to confuse your audience even more. I think my personal advice would be, with the right guidance, they're not as scary as they seem to be. If you can get your head around a limited company, you know, if your audience are directors, then we're looking at a limited company immediately. And if you can navigate yourself around the limited company or the corporate structure, then trust is something that I'm pretty sure you'd be able to navigate yourself around. It's a separate legal entity. From a tax perspective, you're taxed more, the trust is taxed more as an individual rather than a company. In terms of the pros and cons, trusts were very, very popular back in the day. But since 2017, the rules were tightened. In terms of benefits, you can get value outside of your estate without any inheritance tax nor capital gains tax. And therefore, that's one of the reasons. I'm talking from a tax perspective. Trust from a tax perspective, where you're getting value outside of your estate for inheritance tax purposes. There are other benefits, such as legal protection. So it might be a case where parents or grandparents want to transfer assets to their son, but they know that he's going through marital issues. So now, do we transfer the assets directly to the son, or do we put it into the trust and the lawyers draft the trust deed in such a way where the assets remain within the bloodline? This is a common conversation that I'm currently having, which is parents, grandparents, they specifically tell me on our first call that I want the assets to remain within the bloodline, which is a fair point to make, you know, and that's where trusts come into play, because once you transfer assets directly to the individual, then, you know, in light of divorce, bankruptcy, any other issues, because the assets are held personally, that's where you start having further issues in terms of, you know, whatever it may be.
We're going to move on to the autumn budget. Okay, so I'd like to hear your thoughts on what you think is going to happen. Maybe dive into what you think is going to happen that people are not prepared for. What's the one thing that you think is coming out in the budget that people aren't prepared for?
So I've been saying about the autumn budget that's coming up, I've been saying for many months now, when you look at this, the state of affairs currently within the UK, for me it was pretty obvious that we were going to see further tax rises. And I've been saying this for months, before anyone's even talking about the budget. I've posted on LinkedIn a few times that come the autumn budget and we'll see further tax rises, as we did last year. Now we're starting to hear more about, you know, what the government's plans are, and what they tend to do is they leak certain aspects to the media and assess public feedback. Okay, so there's a few things that are being spoken about as of now, which is a new property tax. Okay, and I actually shot a video yesterday about this property tax, my views, and I don't know the ins and outs as of now. Legislation, obviously, that will come further down the line, but ultimately, assets or property worth more than £500,000 will be subject to a certain tax. Now, although it sounds like it's a property wealth tax, so it's like a tax on millionaires, that's not actually the case, because when you go down south again, you know, most properties are worth £500,000, and then even up north, you know, it's not quite easy. It's not the biggest of £500,000. Is not the largest of value when you think about it.
And it's a flat in London, isn't it? It's not even a terraced house. In Essex, it's a terraced house, isn't it?
Correct, exactly. So therefore, you'll have your, again, it's not a millionaire tax, because you'll have your random, you know, NHS worker that owns a property, a small business owner, whoever it may be. For example, my uncle, he's never been in business. He's just the most random person you'll see on the street, but he bought his London house like 20, 30 years ago. So his property, his house price is worth 1.2 million. So he's going to be affected by this tax that everyone thinks is for millionaires, but he's not a millionaire at all. Obviously, he's asset rich, but not cash rich. That's the other thing with property. In terms of what my thoughts are as to what we'll see in the budget, I'll be very honest with you, it's very, very difficult to say. But there are talks around the potentially exempt transfer for inheritance tax, which we spoke about, which is it's subject to tax. It's subject to tax, but if you survive 7 years, then that transfer is not subject to inheritance tax. My thoughts are that's something that might be attacked. So they might, increase that 7 years to 10 years, for example. Or they may just say, any gifts in lifetime, including cash, is subject to inheritance tax immediately, which is, a very bad situation. I think one thing that I do want to mention for business owners, something that they need to look at immediately, is based on last year's budget, whereby business property relief, which was previously, or which currently is available on business assets to be allowed to be exempt for inheritance tax at 100%. So, sorry, I'll start that bit again. Business property relief currently, as at today, allows trading businesses to be completely exempt for inheritance tax purposes. So the value of your business might be 1 million, 2 million, 20 million, 50 million, 100 million. That whole value, the shares in that trading company, is completely exempt for inheritance tax purposes as at today. However, since the budget last year, from April 2026, only £1 million will be exempt. The balance will be subject to inheritance tax at 20%. Now, so many businesses, their value exceeds £1 million quite easily. After a while, especially if you've been profitable for a couple of years, value exceeds £1 million. So if you own shares in a trading company worth £10 million today, and you passed away today, you'll pay no inheritance tax. But if you pass away on April the 7th, 2026, you'll have the 1 million free, okay? But then the 9 million will be subject to 20%, which is 1.8 million, which is a massive difference overnight. And therefore, business owners, they must start planning from today. There are structures, again, as I've mentioned before, there are structures that we have in place using trusts, family investment companies, everything that I've mentioned. It's just about us guiding you and putting things in the right place, in the right order, right timing. These structures will allow you to, not be stung by this tax.
Bad situation.
Yeah, overnight you'll be stung, but these structures, if you plan from now and implement, or even it might just be passing on assets now to the next generation, and you've sidestepped the business, the inheritance tax exposure.
What is the one bit of business advice that you would give to any 30-year-old entrepreneur in the UK today to hopefully save them years of stress?
Good question. My joke answer would be leave the UK, look for a tax-free haven.
I'm after this. I'm ready. I'm going home to my missus and go. Honestly, he's frightening the life out of me. This guy.
Sorry,
Let's go.
I'm really sorry. No. But to be honest, you do see a lot of 30-year-olds now starting to leave the UK.
Yeah.
10 years ago, the UK was an excellent place to do business, and unfortunately, I don't like to be pessimistic, okay? But at the same time, we have to be a realist, which is this is the situation. Yeah. Unfortunately, this is the situation, and you can't tax yourself or you can't tax the country into prosperity.
No.
And that's unfortunately what we're seeing, and business owners are taking the brunt of it. And I also believe that in the budget that we'll see in October or early November, I think business owners will be hit again, unfortunately, because there's no other angle to hit. So capital taxes and business owners will need to be careful. For 30-year-olds, I would say that depending on what you're getting into, the path that you want to go down, always have a chartered tax advisor on board. we're not, from that aspect, when I say having on board, we're not expensive. Honestly, if you just want to have a conversation with myself, for example, I'm happy to speak to you for an hour and just assess your situation and just give you little pointers. And sometimes it's the little things that make all the difference. For example, if you're looking to get into property, you're in your 30s, you're looking to get into property. Let's get the structure right from now. Because so many clients, again, in their 40s, 50s, they have so many properties, but they know now that the structure is all over the place. And then you sort of, you might end up being hit with further tax charges by restructuring. And therefore, those that are starting their business journey, the 30-year-olds, best to seek advice earlier, sooner rather than later. And, let's just see what we can do for you. If there's nothing we can do for you, I'm sure you can get some benefit from having a free conversation.
Omar, I've loved our conversation. Like, really thorough, proper nuggets of wisdom. If people want to find out more about you, where can they see more of you, and how can they get in touch with you?
I think the best place would be our website to begin with, www.aswatax.co.uk. We are in the process of setting up a fresh new website. One of the mistakes that I made when I set up, and this is advice to the 30-year-olds, is I went for a cheap website. When you start out, you're just thinking about costs and you're trying to reduce costs as far as possible. And I've ended up spending way more. So now I've invested in a website that will be rigid and good for me for the next 10 years at least. And that I can relate back to tax advice, which is, if you're looking for the cheap advice, then you'll end up spending way more in the long term.
Cheap advice is worth every penny.
Literally. So
and we can find you on YouTube.
You can find me on YouTube and LinkedIn. I'm personally active on LinkedIn. So TikTok and Instagram, we're on there as well, but my colleague manages that aspect. YouTube, I'm involved. I try to answer comments where I can. But LinkedIn, you'll find me day to day talking about what's actually happening. So I posted about this podcast yesterday, saying I'm going to be here. We shot this short video. I might just post it on LinkedIn as well. So day to day will be LinkedIn, but email address omar@aswatax.co.uk, and
and we will be, one of my team will be reaching out afterwards, so we'll have show notes from this with links to absolutely everything.
Beautiful.
Omar, it's been an absolute pleasure, man.
Thank you very much for having me, Chris.
Take care, buddy. Thank you.
Cheers. Thank you.